The average American now pays over $2,500 a year for full coverage car insurance. That is not a typo. And if you thought the recent tariff drama was just about new car prices going up, you are missing the part that is quietly draining your bank account right now. According to a study from Insurify, the 25% tariff on imported auto parts is projected to raise insurance premiums by an average of 8%. That is roughly $189 more per year, on top of rates that have already climbed nearly 60% since 2022. The worst part? Most drivers will not see it coming until they open their next renewal notice. Today, I am going to show you exactly why this is happening, how bad it is about to get, and 5 specific moves you can make right now to keep your premiums from spiraling out of control. One of them could save you up to 30% on your next bill, and most people have never even tried it. Here is the part that trips people up. The 25% tariff on imported cars and auto parts was never struck down by the Supreme Court. That February 2026 ruling wiped out the broad country-specific tariffs, but the Section 232 tariffs on vehicles, auto parts, steel, and aluminum were imposed under a completely different law. They were not part of that case. They are still active. Every engine, transmission, electrical component, and body panel imported into the US still carries a 25% duty. And here is where your insurance bill enters the picture. According to the American Property Casualty Insurance Association, about 6 out of every 10 replacement parts used in US auto shop repairs are imported from Mexico, Canada, and China. When a mechanic replaces your bumper, your alternator, or your headlight assembly, those parts cost significantly more than they did 2 years ago. Your insurance company is the one paying that repair bill when you file a claim. And insurance companies do not absorb costs out of the goodness of their hearts. They pass them straight to you through higher premiums. Every single driver in America is somewhere in that chain right now, whether they realize it or not. Let's put real figures on this. Insurify's research shows that without tariffs, car insurance premiums were already going to rise about 5% in 2026. The tariffs add another 3 percentage points on top of that, bringing the total projected increase to 8%. That pushes the average annual full coverage premium from around $2,313 up to roughly $2,502. For some drivers in high-cost states like Florida, New York, and Louisiana, premiums already exceed $3,000 a year. An extra 8% on that is not pocket change, and it gets specific depending on what you drive. According to Wawanisa Insurance, popular vehicles like the Honda Civic and the Chevy Silverado are seeing replacement part costs jump 15% to 25% because they rely heavily on imported electronics, engine components, steel, and aluminum. Mitchell International, one of the largest collision data companies, reported that bumper cover inflation alone went from 3.2% in 2024 to 6.7% in 2025, driven directly by tariff-affected raw materials. That trend is expected to accelerate through 2026. The insurance industry typically takes 12 to 18 months to fully adjust pricing to new cost realities. The tariffs on auto parts took effect in mid-2025, which means right now, in 2026, is exactly when the premium increases are hitting renewal notices. There is a secondary effect that almost nobody is talking about. When repair costs go up, more vehicles cross what insurers call the total loss threshold. If the cost to repair your car exceeds roughly 70% to 80% of its value, depending on the state, the insurer totals it and writes you a check instead of fixing it. In practice, that check is based on your car's current market value minus your deductible, and it may not be enough to buy a comparable replacement in today's market. So you go from having a drivable car with some damage to holding a check that does not quite cover a replacement. Tariff-driven repair costs are pushing more vehicles into this trap, especially older cars. If you drive a car worth $8,000 and a fender bender now costs $6,500 to fix instead of $5,000, the math flips against you fast. The tariffs are not going anywhere soon, but your insurance bill does not have to be a number you just accept. Here are 5 things you can do right now to push back. First, compare quotes every single renewal period. This is the single most effective move most drivers never make. Insurify data shows that since 2021, 22% more policyholders are switching carriers because insurers price new customers more aggressively than loyal ones. Spending 20 minutes getting 3 to 4 quotes before your renewal could save you hundreds of dollars a year. The same coverage, the same limits, wildly different prices. Second, raise your deductible. According to the Insurance Information Institute, raising your deductible from $200 to $500 can cut your collision and comprehensive costs by up to 30%. The trade-off is you pay more out of pocket if you file a claim, so stash that deductible amount in savings where you can access it. But for drivers who rarely file claims, this is the fastest way to drop your premium immediately. Third, try a telematics program. Companies like Progressive, Allstate, and State Farm offer apps that track your driving and reward safe behavior. According to Policy Genius, drivers who enroll save an average of 20%, with some programs offering up to 30% to 40% in discounts. Most insurers give you a 5% to 10% discount just for signing up. Fair warning, if you drive aggressively or log a lot of late-night miles, it could raise your rate. But for steady, low-mileage drivers, it is essentially free money. Fourth, review your coverage on older vehicles. If your car is worth less than 10 times your annual premium for collision and comprehensive, those coverages may not be worth carrying. Dropping them on an older vehicle can save you a significant chunk without meaningful risk. You are paying to insure a car the company might total anyway. Fifth, bundle your policies. If you have home or renter's insurance with a different company, combining it with your auto policy can save you up to 25% depending on the insurer and your state. It takes one phone call. Car insurance was already expensive before the tariffs. Now it is getting squeezed from both sides. Repair costs climbing, and insurance companies adjusting premiums to match. The 25% tariff on imported auto parts is not a temporary headline. It is a structural cost increase flowing through to every driver's bill. But the drivers who spend 30 minutes comparing quotes, reviewing coverage, and adjusting their deductible are going to come out ahead by hundreds, sometimes over $1,000 a year. Do not wait for the renewal notice to surprise you. And if you missed our first video about why your next car repair will cost 25% more, go watch that one next. The repair bill and the insurance bill are two halves of the same problem. Drop a comment and tell me which tip you are going to try first. If this video was useful, do me a favor and hit that like button. It only takes a second and helps more drivers find this channel before they make costly mistakes. For straight talk, no fluff, helpful videos, subscribe, and turn on notifications. I post new videos every week, and every single one is designed to save you money and make your life easier. And please share it, because the best thing you can do for a friend is make sure they see this before they need it.